Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach you. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. Sometimes you get these days where it feels like the market has returned to some semblance of what you're used to when things get shaky. I mean, these are the days when J&J will reign supreme, or Merck makes a comeback, or Procter & Gamble has a big run. Or, with crypto taking a little bit of breather, you get a gigantic move in gold. Now, the averages don't show it. Dow gaining 179 points. S&P advancing 0.06%. NASDAQ declining 0.39%. But this was a day of turmoil because the stocks that have been beaten up endlessly, mainly the foods and the drugs and their fellow travelers in the restaurant space, all rallied. While the speculative stocks and anything involving the data center, it's been so hot, they get blown out of the water. It's a day when AppLovin, the company that helps mobile video games grow their reach and monetize their games through advertising, gets crushed, down 4.4%. A day when Coinbase gets hobbled and Robinhood looks weak. And get this. I know it's going to come as a shock. Even mighty Palantir hits a speed bump. Palantir saying ain't so. You can go down too. All right, this is what we call rotation. The stocks have been hit so hard, deserve it. Give them a couple days or even 3 in the sun. So many of them now have high yields. They're perceived as having something to fall back on. Plus, when a good company with a good balance sheet gets that low, it's at the least time to cover your short positions. And I saw that all over the place. I'm not going to go against a market that's signaling that interest rates are coming down. That's what today did. And the high flyers have flown too high, while the companies with good dividends have gotten too low. This is just temporary. So what are you supposed to do then? First, know that the rotations are not investable, but at best, they're tradable. Sell. Take Campbell's or General Mills. Both yield almost 5%. Both are good companies, just not as good, maybe not as good as PepsiCo, but they're in the same league, especially because PepsiCo is now up almost 20 points from its low. Why? It's important to remember that PepsiCo reported a terrific quarter with sugar, water, and Frito-Lay, 2 categories that were supposed to be on life support thanks to the rise of the GLP-1 weight loss drugs. Those injections reduce your craving for junk food. PepsiCo sold a ton of junk food. So if people are craving chips and soda again, maybe they'll also crave food from General Mills and Campbell's, neither of which has the calories of Doritos or the chemicals of soda. But let's take a step back for a second. Why is this rotation even happening? I think it's because, once again, the traders are looking at interest rates, imagining that there's going to be a recession. So they're buying up what typically does well in a recession and ringing the register on everything else. I have to tell you that looking at the yield curve, actually measuring where the yield curve is, with the 10-year at 4.3% and the 30-year at 4.9% dropping nicely, that's causing so much nervousness in stocks you have to say, whoa, how long can this rotation go on? Didn't we just pass the biggest budget-busting bill in years? Weren't interest rates supposed to go up, not down? Should we really decide, for example, that D.R. Horton, the homebuilder, should see its stock soar 17% off that okay quarter? Well, actually, a little better than okay. First, the homebuilders never should have been down so much in the first place, so think of today as a course correction. More on that later. Second, though, these moves are all caused by rates, or at least rates today. Now, I hear all the chatter about how this is the end of the rally that brought us here. We take note of the troubles of Stargate, the creation of OpenAI's Sam Altman and SoftBank, and we reach the conclusion that the data center bull market is over. That fiasco is bringing down a host of usual suspects that have been rallying nicely, including NVIDIA, which fell 2.5%. To me, it's a moment where the winners had to cool off and the losers had to play catch-up. Last night I said that there's so many speculative stocks that you call on, and light around, with parabolic moves, that the market simply has to cool down. Parabolic moves always end badly. We don't want them to end real badly. Taking their place in the winner's circle are the utilities and the beaten-down stocks like Target with its nearly 4.3% yield, or even Starbucks with a 2.5% yield and the possibility of a real turn. There are some unusual oddities. For example, why the heck are the transports rallying? What is that about? If people think we're heading into a recession, as the bond market seems to indicate, then the transports should be getting slaughtered. Does it make sense that GM at a 5 price-to-earnings ratio would be clubbed on a missed quarter? Yes, if the economy is truly slowing down. But what if you wanted to take the other side of the trade? I think you'd be coming in a little too early at this point in the rotation. My guess is that there'll be maybe 2 or even maybe 3 days where interest rates are lower. This was day 1. And you have to wait as the food and drug analysts come out from under the table and start bragging loudly about their flock and about how it's time to buy. That's what those guys always do. See, I can see where Procter & Gamble could have another good day, maybe even two, based on the weaker dollar. What analysts could resist a price target boost there? Which analysts are going to resist going out positive on J&J, which has moved up every day, seemingly, since the last quarter? Since they announced that quarter, maybe the food analysts can talk up mergers. These are all they're reasonable presumptions. And they will preclude a serious tech rally or a speculative surge. Hear what I said? Preclude. It's still too early to buy the momentum stocks. These rotations usually sap you for 3 days. They continue to try to make that point. Today's day one. Of course, that could change if interest rates suddenly jump higher. But it would be best to accept that the food and drugs can have a couple of days in the sun, can't they? The old leaders pull back a little, can't they? Don't be in a hurry to buy Lam Research or Applied Materials or KLA from the semiconductor capital equipment side. Not after we had Texas Instruments on tonight. I wouldn't step in front of the falling knives that represent any of the meme stocks, save Kohl's, which we'll talk about later. I know it's hard with so many people saying that this is the beginning of the big correction to point out that plenty of stocks are actually doing quite well and just playing catch-up. But that's all they're doing. The market hasn't changed stripes, but the people who come on TV have. It's just wearing a different style for a few days while it waits for the dry cleaning to come back. And in the case of Dan Ives, maybe, I don't know, never. The one thing that's truly irrational here is that the bond market itself is signaling all the wrong things. The president passed the most aggressive budget-busting, beautiful bill imaginable. For months, all we heard about is how our country's in trouble because we added $3 trillion or more to the budget deficit. So how the heck can the bonds stay strong, meaning rates go low? The answer? The bonds are wrong. They'll soon revert to going higher in yield and lower in price, but right now, people seem to have forgotten what they've been worrying about for many months. The bottom line, okay, listen to me. I say let the rotation play out. Give it some space. The stocks that are rallying have been down for days, maybe weeks, maybe even in some cases months. They aren't going to start going down again until we forget what Stargate was, or confuse it perhaps with Starbucks, or Star Wars, or even Star Trek. And we get a couple of earnings reports from the consumer staples that are disappointing. Well, you can certainly count on those. Then again, then we'll be back buying all that stuff, including a Palantir, which is what you call Palantir when it's going down. But not until then, so don't jump the gun. Palantir. Don't you love that, Palantir? I mean, come on. All right, Ann in Indiana. Ann.
Hey, Jim. Thanks for taking my call. So I saw an article in the Wall Street Journal about J.P. Morgan, but they mentioned that Goldman Sachs private credit division financed part of the Walgreens Shields deal, and the leverage was 9 on the deal. Is that the kind of business they're going to do in their private?
I don't know. Sweeney, Rob Sweeney, my friend Rob Sweeney, or my wife would say an acquaintance Rob Sweeney, is doing that deal, and he's real money good. So I see why they might have done that, and Tim Wentworth's there too. I don't know. I mean, I'm a believer. I wouldn't leave that deal even if I tried. Let's go to Brian in Massachusetts, please. Brian.
Hey, Jim. Hope you're doing well and got to catch the UFC fights this weekend. It was a great fight between Holloway and Poirier, two of the greats.
Excellent.
On that topic, with TKO's upcoming sports rights renewals likely to go for a significant AAV multiple and the recent integration of UFC and WWE's global partnership teams, how much upside do you see from the cross-promotional advertising?
Okay, that stock is a momentum stock, and I'm saying that momentum's got 2 more days of downside, and it worries me. I'm not going to jump on the TKO bandwagon if we have 2 more days of momentum pain. I'm talking about
the House of Pain.
And I'm not a player. Look, we have to let the rotation play out. That's all I'm saying. Don't jump the gun yet. On Made Money Tonight, Domino's was up and then down all around after earnings. I'm breaking down the action, showing if I think the stock is more room to run. Then for years, we've seen this incredible run in the price of cattle. So is this rally just beefing up, or could it begin to move lower? Can you tell the stuff that I write versus others? All right, I'm going out to the charts to find out. And look at D.R. Horton go, up over 16% today. Should investors start building a thesis on the home builders, or maybe take a wait-and-see approach after this monster bounce? I'm going to give you my take, so stay with Cramer.
Don't miss miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, sometimes a company reports, and Wall Street can't seem to decide whether to send the stock in question higher or lower. That's exactly what we saw yesterday morning when we got results from a name you all know, Domino's Pizza. I was getting ready for the 9 o'clock hour of Squawk on the Street when the Domino's quarter hit the tape, and the market's initial reaction was overwhelmingly positive, yes, with the stock soaring in pre-market trading. At 9:30, it opened almost 5% and was up as much as 6.4% in those first few minutes of trading. But when I checked back in on the stock midday, it was trading down as much as 2.8%. Throughout the session, Domino's flipped through positive and negative, for ultimately closing lower by less than 1%. Then today it rallied. What did it do? It was up it was $19 or 4%. So what the heck is it about this quarter that had the market so confounded? Well, let's find out, because this is really what the essence of what investing may mean at this point in the cycle. Okay, I thought this was a good quarter. Domino's posted 3.4% domestic same-store sales growth. Analysts were only looking for 2%, mostly thanks to market share gains. That said, the earnings came in at $3.81 per share. Wall Street was looking for $3.94. However, that entire shortfall came from an unfavorable, what's known as mark-to-market adjustment related to the company's investment in DPC Dash, which is Domino's master franchisee in China. This is a non-cash item that happens every quarter, yet it wasn't reflected in the estimates. I'm not concerned. Instead, I'm much more focused on the market share gains and strong same-store sales. Back in April, I got the chance to speak with CEO Russell Weiner. I like this guy. He's smart. He had a lot to say about the then recently launched Parmesan stuffed crust pizza. He predicted a big launch. All right, now listen to this. Stuffed crust pizza isn't anything new. But apparently Domino's did it very well, because this was the biggest launch in company history, exceeding all of management's expectations. Apparently it's also done a great job of bringing in new customers. What makes this more significant is that stuffed crust pizza has long been associated with Domino's top competitors, first Pizza Hut and then more recently Papa John's. When yesterday's conference call, management acknowledged that the absence of a stuffed crust option had been previously, it was a, quote, big reason why Domino's customers would go elsewhere in the past, end quote. Now they've plugged that hole. I think it's helping them pick up some market share. At the same time, Domino's represents a terrific value proposition. This is something that we've seen in virtually all the winners in the restaurant space. If you can offer customers real value, you can win in this environment. And in terms of value, it's really hard to come close to Domino's with its $6.99 mix and match deal for 2 or more items each, which includes medium to 2 topping pizzas. There's also the perfect combo deal, which bundles 2 medium 1 topping pizzas, 16 Parmesan bread bites, 8 cinnamon twists, and a 2-liter bottle of Coke, all for just $19.99. That's so cheap, it's almost a threat to public health, for heaven's sake. Hey, by the way, I've had the first one of these 2 offerings with my daughter. Yeah. Beyond the new menu items and the value proposition, Domino's saw a pickup in same-store sales thanks to the recent rollout on DoorDash. So how come Wall Street couldn't figure out what to make of this quarter? Why did the stock bounce around so much yesterday? Why was it wrong? Here's the thing. During the Q&A session on the conference call, the analysts sounded encouraged by all the positives I just mentioned, but there was a lingering doubt, a concern about what comes next for Domino's. In short, some analysts worry that the company will struggle while it laps hard comparisons moving forward without a clear catalyst. Now, but for those taking that stance, there are a few key factors that they may be overlooking. For starters, Domino's value proposition isn't going anywhere. In fact, management's doubling down with a new promotion currently underway, which they call, quote, the best deal ever, end quote. It's probably really the best deal ever, right? I mean, this offer allows customers to order any pizza with any toppings for just $9.99 each, Management sounds very confident about this one. What else did the Bears overlook yesterday? Well, how about Domino's partnership with Uber Eats and DoorDash? They're more than just vehicles for driving incremental sales. As management highlighted on the call, customers on these platforms tend to be higher income, and the company's hopeful that some of these people will start coming directly to the store after they've introduced via these online delivery platforms. I'm not sure that'll happen, but I do think that, let's say the wealthy are ordering more Domino's than they used to. Back in April, CEO Russell Weiner gave us a convincing argument for why he believes Domino's is still in the early innings of growth from these third-party delivery services. Listen to this.
We stayed out of the aggregator marketplace for a while. We don't want to help it grow, but it's a big piece of where people order today, and we need to meet customers where they are. There's about $5 billion worth of pizza that are sold in the aggregator marketplace. About $1 billion of it could be ours. That's our fair share if we were on aggregators. Last year we got on Uber. We're getting towards, in May and towards the second half of this year, we'll be on DoorDash. DoorDash sells about twice as many pizzas as Uber.
I find that to be very encouraging. Now, what about the idea that Domino's will struggle next year as it comes up against these tougher comparisons? Well, on the call, Russell made a compelling case that the company will keep gaining market share. He pointed out these competitive advantages have already helped Domino's capture a, quote, a share point a year every year for the last decade, end quote. That's fantastic. Russell highlighted several key advantages that enable Domino's to keep delivering value to customers, like lower supply chain pricing that helps franchisees remain profitable while keeping prices low for the customer, and a large advertising budget that helps drive volumes. But none of this came as a surprise to me because, hey, listen, we heard it all last time when Russell was on in April. Listen to this.
Think about if customers are looking for value, what do you need to provide them value? You need a best-in-class supply chain that has scale, that doesn't pass on high prices to franchisees, so they don't have to pass them on to customers. You need huge advertising budget, right? Because if percentage margin is low, you want the cash margin to be high. You need lots of volume. We have a $500 million marketing budget. And then you need franchisees that are well capitalized. The average EBITDA of our stores last year was $162,000, which by far is best in class.
See, Russell was spot on about a company's growth drivers in the second quarter when I spoke with him in April. I bet he's correct when he says he'll be able to leverage the scale of this chain to continue delivering growth in the future. That's something the Bears seemed to overlook yesterday. But it appears the market's starting to recognize it today as the stock really was roaring back. And I know Russell, and I know him well, and I think that people are underestimating. When he says things are the best ever, he means it. Bottom line. I like what I'm seeing from Domino's and trust that management can use all the tools at their disposal to sustain their growth, which means this stock could have quite a bit more upside. The only thing that may be missing, listen, Russell, is a stock split. Now, I know splits don't create any actual value. I know the institutions don't like them. But the same people who buy Domino's Pizza would be willing to buy the stock if it was 48 instead of 480. Come on, Russell. Show those institutions that you work for the shareholders and the pizza buyers, who often are the exact same people. Their money's back after the break.
Coming up, a new meaning of a bull market? Cramer is going off the charts and looking at the recent rise in beef and cattle prices and whether or not you should steer clear for now. Next.
For years now, we've had a stampeding bull market in the price of cattle, which is why the price of a steak has risen to borderline extortionate levels. Normally, when you talk to commodity traders, they'll say that the cure for high prices is high prices. Eventually, people refuse to pay up and start finding alternatives. But for 5 years now, 5 years, the price of beef has exceeded even the most wildly bullish expectations. So can it keep climbing, or will the beef boom turn into an inevitable beef bust? To answer that question, we're going off the charts with our resident commodities expert, Carly Garner, a brilliant technician, who's the co-founder of DeCarly Trading and the author of Higher Probability Commodity Trading. Garner's not a believer in the beef bull market, believe it or not. Consumers don't have unlimited budgets, so sooner or later they'll swap out a red meat for poultry, pork, or fish. But cattle prices just keep going higher. Now, some of that's because supply is historically tight. Garner points out that we've closed the southern border to the meat trade because of the screwworm fly outbreak in Mexico. These things will eat cows alive from the inside out. At the same time, the president's 50% tariff on Brazil, effective August 1st, could add additional supply constraints in the beef market. But Garner notes that while there are fewer heads of cattle these days, each animal weighs more than ever. So supply is stretched, but maybe not as stretched as most people are assuming. So let's do this. Let's take a look at the monthly chart of live cattle futures, which is now in overbought territory. Will you look at this? When you look at the RSI index, so RSI is down here, okay? This is really overbought. At the top of that, Garner says we're seeing divergence between the underlying futures contract and the RSI. In other words, the price of cattle futures is making new highs, but the relative strength index has been moving sideways. According to Garner, this kind of situation can persist for longer than you might expect when you're dealing with commodities. But in the long run, it's totally unsustainable. This is an unsustainable run, people. Unlike stocks, which can and do move higher overall, commodities generally trade sideways to lower over time. That's because new technology is inherently deflationary, while consumer demand is elastic. Garner notes that the last cattle market boom spanned from 2009 to 2014. After that impressive 5-year run backed by extremely tight supplies, the consumer threw in the towel, and so did the cattle bull market. Eventually, people just stopped buying beef. That matters because the current bull market has also lasted for 5 years. So far, consumers have accepted higher beef prices, but if history repeats, we could be nearing the breaking point. What makes cattle prices tricky, though, is that they've become wildly dependent on the direction of the S&P 500. Over the past 60 trading days, Garner points out the S&P and the cattle prices have moved in the same direction 80% of the time. Now, you could argue this comes down to the wealth effect. Higher stocks mean people have more money, which they can therefore spend on overpriced beef. You know, I'm not buying that. Either way, cattle prices seem joined at the hip with the S&P. Now, let's talk about the S&P 500. Take a look at this monthly chart, okay? Garner wouldn't be surprised if the S&P 500 rallies to 6,500 in the coming week or two. But Garner says that seasonality often turns sour in late July and in August. Historically, when the market enters earnings season hot, it usually exits the other end cold because of the buy the rumor and sell the news phenomena. Unfortunately, these seasonal headwinds coincide with serious technical resistance. Garner has long been a believer that if not for the government's aggressive stimulus during the pandemic, the S&P would have remained stuck in the post-financial crisis trading range as depicted by the black lines on the chart. That much, much lower than where we are now. We're now in a new range defined by the blue lines. But every time the S&P touches the top of that range with an overbought relative strength index, like we have now, Garner points out the market's sold off hard. If that pattern continues, she thinks it'll be challenging for the S&P 500 to surpass 6,500 on this pass. And if it fails to break through, the closest real floor of support is 5750. Although Garner would be surprised if we come all the way down to 5250 in a major correction. We might even retest the highs of the old trading range near 4,800. Garner's not saying that that's where we're headed, but she thinks the S&P has reached a point where the potential upside is limited, while the potential downside is, get this, enormous. Bad news for stocks and also bad news for cattle prices, which have been trading the same direction as stocks about 80% of the time. What else is correlated with the cattle futures? Well, how about the U.S. dollar index, which measures the greenback against a basket of foreign currencies? Throughout the previous 60 trading days, the dollar index and live cattle futures have settled in the opposite direction just under half the time. While that's not the strongest correlation out there, a stronger dollar would clearly put pressure on cattle prices. The stronger the dollar gets, the cheaper it is for us to import beef from, say, Argentina. Of course, lately the dollar's been weakening. But take a look at the monthly chart of the dollar index futures. Wow, a lot here to digest. To Garner, it sure looks like our currency has put in a bottom. Thus far, she points out that Trump 2.0 has played out identically to Trump 1.0 in terms of the dollar. The greenback rallied into the transfer of power to the Trump administration with a temporary breakout followed by a precipitous nearly 15-point decline in the dollar index. During the first Trump presidency, the dollar index sell-off fell slightly short of the money trend line and rallied sharply to the top of the range before retreating to the lower trend line. If this pattern continues to hold, then she'd expect the dollar index to rebound from 97, where it is now, to 110. Okay, not that much, but still, before eventually pulling back again. To put this in perspective, just that the shift in exchange rates could pull live cattle prices from $2.25 where they are now down to $1.80. In the end, Garner believes that when it comes to commodities, the fundamental narrative is always loudest at the top or the bottom. For example, when oil peaked at $150 in 2008, most of the world believed we're running out of fossil fuels. Then the economy collapsed, and we invented new technologies like fracking to unleash all sorts of previously inaccessible oil and gas fields. Livestock is obviously a different animal. Rebuilding herds takes time, 9 months to give birth, then another 2 years for the new cow to grow up. But as Garner sees it, high prices encourage ranchers to get their heifers making calves as fast as possible, while encouraging consumers to eat literally anything other than beef. Plus, when egg prices got too high, the government took unprecedented action to increase supply. Maybe something similar could happen with beef. Here's the bottom line. High beef prices have been agonizing for me personally. But the charts as interpreted by Carly Garner suggest that there's only so long that this can go on before the cost of cattle comes back down. I want to take questions. I want to start with Gary in Maryland. Gary.
Jim, booyah. It's an honor to be on your show. I've been watching you for over 20 years.
Oh, so, you're too kind, man. You're too kind.
Yeah,
Thank you, buddy.
I've been watching it for a long time. It's a good show. I always watch it. I don't miss it. Try not to always miss it. I don't want to miss it. It's very good. I want to find out about this. I want to find out about this stock, Caesars Entertainment. I'm not
a buyer of Caesars Entertainment. I understand. I mean, I read that book, by the way, about Caesars. Thank you, Ben Stoddard, for giving it to me. It doesn't influence my thinking other than say that I don't know why we want to be in this also ran. If you want to be in casino, you want to be in Wynn, okay? Wynn is the way to go. Now let's go to Hutch in New Jersey. Hutch.
Hey, Jim. It's Hutch from New Jersey. How are you?
I'm doing well, Hutch. How you been?
Good. Hey, I was thinking, Salesforce. What do you think about that?
You know what? People don't like these software companies. Now, we have a small position of it for my charitable trust because we've owned it for years and years and years. I think that the software stocks have been a not great place to be. This is one of them. And I do think that that there are fewer and fewer people who want the software stocks because they're licensed stocks. And with when you have what I regard as being, let's say, generative AI, you do not necessarily need as many people at the company. And if that's the case, then therefore you won't have as many what's known as seats, people who will subscribe to Salesforce. So I think that's what's really alien. Not as many customers available. Let's go to Ian in Florida, please. Ian.
Hey, booyah, Jim. How you doing?
I'm doing well. How about you?
I'm doing great. Thank you. Jim, I wanted to ask you about a semiconductor stock that was looking like it had a nice uptrend for a while. I like the company. What do you think about Marvell?
You know what? I think it should have gone up after that last quarter. I think Matt Murphy did a terrific job. I don't really understand the sustained decline. I think that this stock could be ready to roll. Now, Texas Instruments reported a number tonight and again gave weak guidance. Now, they're not exactly the same, but I will tell you that I think that you could see this stock down along with Texas Instruments because Texas Instruments was that bad. Okay, the charts as interpreted by Carly Garner suggest that these elevated cattle prices might come down soon. What can I say? She's not that bullish. All right, now much more mad money ahead. The Homebuilder spent the better part of a year in the doghouse, but wow, this D.R. Horton came roaring back today. Is this the turn we needed to get the sector back on track? Or is it one giant short squeeze? I'm digging into the latest. Then the meme trade has set its sights on Kohl's. And I'm sharing why this particular stock caught the attention of social media. And of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. After struggling for the better part of a year, the homebuilders came roaring back today, led by D.R. Horton, the largest homebuilder in America. After it was basically a 2.5-year rally, the homebuilders ran into a bit of trouble late last year with some housing markets cooling off significantly, especially Florida, but also Arizona, the Southwest. And I think you could also blame stubbornly high mortgage rates. When tariff-related recession worries entered the picture earlier this year, the whole group got clobbered again. For example, D.R. Horton pulled back 45% from its September highs to its April lows. Since then, though, these stocks have quietly been making a comeback. Buy! As the recession worries subsided, and there's been some hope of lower rates on the horizon. We kind of saw maybe the beginning of that today. Horton rebounded from 110 to 131 as of last night's close. Then this morning, the company shot the lights out D.R. Horton reported 23,168 homes closed in the second quarter. That's what other home builders call deliveries. And that was down 4% year over year, but nicely ahead of the 22,040 number that Wall Street was looking for. The average selling price comes in at $369,000. Remember, these guys sell lower-end homes, pretty much in line with consensus estimates. And home building revenue came in at $8.56 billion. All right, down 7% year over year, but much, much better than the $8.19 billion that the analysts were expecting. Expectations have been reduced, and now they were handily beaten. D.R. Horton also, their total revenue, which also includes results from the company's smaller lot development company, Four-Star Group, as well as its rental operations, came to $9.23 billion, when the analysts were only looking for $8.75 billion. The company's margins were substantially better than expected. Now, that translated into a magnificent 47-cent earnings beat off a $2.89 basis. Again, not great in absolute terms, okay, as the earnings were down 18% year over year. But they crushed the expectations on earnings, and that's what matters. Doesn't hurt that Horton bought back $1.2 billion worth of stock in the quarter. And in fact, they've reduced their share count by 9% over the past 12 months. Fewer shares means more earnings per share. And, by the way, keep this in mind, a more intense short squeeze as the people betting against the stock can't find as much stock to cover. That was part of the rally today. All right, how about these forward-looking numbers that matter so much? Horton's net sale orders were roughly flat year over year, but quite a bit better than expected, especially in dollar terms. Their cancellation rate, 17% in the quarter, a tick down from 18% the year before, and better than the 19% number that Wall Street was looking for. So overall, the orders numbers look pretty solid, even if the company had to compromise a bit on price to get these sales done. Finally, Horton updated its full-year forecast for 2025, which for them is the 12-month period ending in September. The company shaded down its homes closed outlook, but that forecast was still better than expected. They also tightened their consolidated revenue outlook, lowering it slightly at the midpoint, but it's still pretty much in line with expectations. On the positive side, Horton said they plan to repurchase $4.2 to $4.4 billion worth of stock this year. That's up from $4 billion previously. And management reiterated their full-year cash flow from operations forecast. Basically, the company slightly lowered its full-year revenue guidance with just a couple of months left in the fiscal year. But it's still above what the street was expecting. So even though they lowered, it's still better. And the abundant buybacks certainly don't hurt. That's a big reason why the stock shot up an astounding $22 or 17% today. That's one day's trading. An incredible move. Let me see. I don't even have anything that's good enough for this. Just a second.
How's a pleasure.
With some of that coming from what I just mentioned, which was a short squeeze, because lots of hedge funds thought that this group seemed ripe for a bruising, given what President Trump describes as too high interest rates for people to buy homes. At the same time, management gave us some good color on the state of the business during the conference call. Long story short, CEO Paul Romanowski said that even though homes remain relatively unaffordable, we know that, and buyers are cautious, we know that, Horton's been able to cope with this by increasing their sales incentives. Management expects that type of environment to persist through the current quarter, but they're working through it. Now, one negative management mentioned on the call was the fact that their home building gross margin should slip a bit in the current quarter because, quote, incentive costs have increased on recent sales, end quote. But that's already reflected in the updated guidance, which, again, was better than expected. It certainly wasn't enough to derail the buyers. Of course, it didn't hurt that Pulte Group, another major home builder, reported much better than feared quarter this very morning. Oh, and I'm sure nobody in the industry is complaining that President Trump floated a plan to eliminate the capital gains tax on home sales. Now, I'm not the biggest fan of this idea. We just got some huge tax cuts already, and married couples can already exclude up to $500,000 in capital gains in the primary home. So this is something that would only benefit the super uber rich. Besides, I don't see why one kind of capital gain should be treated differently from any other kind of capital gains. Doesn't make any sense. That said, whether or not it's good policy, it would certainly be fabulous for all things housing. I think that was the icing on the cake of the homebuilders rally. Even if the odds of this policy becoming law don't seem that high, although it does seem when the president wants his way, he gets it, doesn't it? And look, the whole group caught fire today. It wasn't just Horton up 17% and Pulte up 11.5%. Toll Brothers and Lennar both shot up more than 8%. And they didn't even have any company-specific news. It was pure pin action. The Homebuilder ETFs like the XHB and the ITB rallied 5.6 and 7.9% respectively. And that really, plus the gigantic short covering, really sent these things flying. At the end of the day, this is a space most investors have been down on a very long time. And, may it still be true despite the group's modest recovery from the lows over the past few months. But these results tell us that home building business just isn't that bad right now, especially when these builders are proactive, reading the market realistically, and offering incentives where needed to keep up their sales volume. So I think that the nation comeback for the builders can continue, at least for the time being. Although eventually this will come down to whether or not the Federal Reserve decides to start cutting interest rates again. But the bottom line, the housing market, while not perfect, is a little more solid than we thought. Expectations so low for the builders. Solid results are enough to allow these stocks to soar like they did today. Wall Street simply got too negative on this group, which is how you get these explosive rallies in D.R. Horton and Pulte Home that spill over into Lennar and Toll Brothers and the rest of the industry. And hey, if you believe we've got tariff-induced inflation under control and the Fed will feel comfortable cutting rates sometime relatively soon, then the home builders could have a lot more room to run. Mad Money is back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It's time for the lightning round. Quiz everybody. That's from Africa. Let me save the stock instead of buy, sell. Just be clear, I know the core stocks ahead of time. My step prayers to grab to apply. You're playing the sound. And then the lightning round is over. Are you ready? Ski daddy, time for the lightning round. Kids. Harry in Georgia. Harry
in Atlanta, Georgia. Club member.
Yes.
And the home of Atlanta to Coca-Cola and Home Depot. And my question tonight, UPS.
You know what? UPS is a real quandary. I love that yield, but I do think that fundamentals are still hurting. I'm going to have to take a pass on that one.
Don't buy.
Now let's go to Arthur in California. Arthur.
Hey, Jim. Happy Tuesday.
Yeah, it feels like forever today. Go ahead.
So I'm calling about, I took a very small position into my Roth, and I was looking to build up more on it. It has good dividends, but it's been on a very downtrend, but not at the all-time lows. That ticker is CAG, Conagra.
Conagra. Okay, here's what's going to happen with Conagra. In the next 2 days, Conagra is going to be up because we're involved in a rotation. And then on day 3, I think you want to exit stage right on Conagra. Let's go to Tanya in South Carolina. Tanya!
Hey, how are you?
I'm just glad to hear your voice, Tanya, frankly. How about you?
I'm great. I have a question about SoundHound.
Okay, so SoundHound is one of those stocks that has to be eviscerated over the next couple of days because it's part of the evisceration crowd. I mean, one of the things that's happened here is we're in a rotation, it's selling all these stocks, and it's buying a stock in Campbell's Soup. Now, that is not necessarily my kind of rotation, but it is one that is going on, and I have to say I would be a little careful. SoundHound. Let's go to Sam, Massachusetts. Sam.
Jim, how are you?
I'm not bad, Sam. How are you?
I'm good. You know, Jim, I was combing through the industrial sector because I was looking to find a stock that was in this bull market for heating, cooling, and ventilation. That's where I came across Modline Manufacturing with its $4.9 billion market cap. The company did roughly $2.3 billion in sales last year, and it's fundamentally looking strong. So I'm curious what you think about Modline, given the bull market.
Well, Modine, look, I think you don't need... Modine's got a lot of good things going. It is a good industrial. It's not a great industrial. We've been buying, just, you know, for a Chapel Trust, we've been buying the stock of Dover. I think Dover is a better play for you than Modine. Let's go to Clark in Louisiana. Clark.
Jim Cramer, incredible. Big fan. Ever since 2005. Shout out to Parkers and Mass who bought me the first Jim Cramer real money. Sane investing in an insane world.
Yeah, that's where Booyah came from. Booyah's from there.
Yeah, buddy.
All right.
Ticker is ETR.
Man, I'll tell you, ETR's had such a run. I know it can go higher, but it got, you know, Meta likes it and everything. I'm going to say right here, don't buy. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, getting the short end of the stick, Cramer's helping you make sense of today's declines in Kohl's and whether the short sellers have it right about the retailer. Next.
It all started on social media. I saw it on Reddit's Wall Street Bet section. It's time to buy the stock of Kohl's. Why? Because of the gigantic short position. That's why. That's why Kohl's didn't shoot up nearly 38% today because of its deal with Sephora. It wasn't about that relationship with Amazon either, where you can return goods bought from Amazon at most of Kohl's stores. And it certainly wasn't Kohl's Cash or some of their store brands, even as I begrudgingly admit that I like them. No, it was all about the short position, which is close to 50%, 5-0 of the float. Yet nearly half of the shares that trade were sold short. Whenever you have such a huge short position, it's easy for buyers to get together online and orchestrate a short squeeze, defenestrating the hedge funds that are shorting it. To which I say, what the heck do the shorts, not the mainstreams, but the shorts think they're doing here? This chain with a balance sheet that isn't all that bad simply should not be that heavily shorted down here. It's moronic. Kohl's may not be great, but it isn't terrible either. For the hedge funds, it's almost as dumb as staying short GameStop in 2021, only to be run over by the social media, specifically the Wall Street Bets outfit and the memesters that bought into the short busting. At the end of September, I have a book coming out. It's called How to Make Money in Any Market, and I got a chapter on GameStop. I try to philosophize about how the Reddit people didn't necessarily love GameStop at all. They didn't go to the store, but they sure hated the shorts, and they wanted to rip their lungs out. When they marshaled the Wall Street Bets crowd, they had the perfect foil to the shorts. Once these longs get on the same page, it was only a matter of time before the short sellers were crushed. I write that the shorts ought to start reading Wall Street Bets because it's a powerful force in favor of a company by happenstance and against shorts by design. And Kohl's was a textbook example of a stock that had become perfect for the GameStop playbook. Ganging up on the shorts was like shooting fish in a barrel. No, I don't like to shop at Kohl's. I find it a dowdy target filled with merchandise that I can get for less than TJX if I'm willing to wait long enough. When the stock was in the 50s 3 years ago, it did get multiple takeover bids from some pretty smart people. Then the company seemed to fall by the wayside and the bids dried up. Maybe that was the clarion call of the short sellers that it was time to operate on Kohl's? I get that. And hey, the shorts have made a killing over the past few years in this one. There were some dubious changes in management and a sense that the chain just can't seem to find a way in a world dominated by Costco, Walmart, and Amazon. The stock was subsequently eviscerated and fell as low as $6 right after Liberation Day. That's precisely when the short should have covered. When a stock you've been betting against goes from 60 to 6, you declare victory and you ring the darn register. After all, three solid acquirers were thinking of buying Kohl's much higher 3 years ago. Wouldn't it be natural to presume that at least one of them might come back at these levels? Look, I don't have a dog in this hunt. I'm not a friend of the shorts or those who are trying to destroy them. I will say that where there's smoke, there may even be some fire, given how this one ignited into a double so fast. The shorts have clearly overstepped their boundaries with Kohl's. They've run into a buzzsaw of their own creation. Even now, I think they'd be wise to cover their short and move on before they have another GameStop on their hands. In the end, the short sellers have the wrong target, a company with declining sales and a lot of debt, but not one that's about to fall apart, which is what you need if you're still shorting Kohl's down here in the single digits. Hedge funds, take my advice. Cover and move on. Like I said, there's always bull market somewhere. I promise to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.